Listen to me. If you own silver right now, there's something happening in the next few hours before the market opens that could fundamentally change whether you're protecting wealth or walking straight into a trap. And most people who hold silver have absolutely no idea this is even occurring. I've spent decades watching institutional money move before the retail world wakes up. And what I'm seeing in the silver space right now is one of those critical inflection points where timing becomes everything. The difference between understanding what's about to happen and being blindsided by it could cost you thousands, maybe tens of thousands. And here's what most people don't grasp. By the time you read about silver in the mainstream financial media tomorrow morning, the real moves have already been made. The institutions have already positioned. The algorithms have already traded. You're always playing catch up, always reacting to a game that was decided before you even knew there was a game being played. Before we go any further, hit subscribe because this channel explains what's really moving markets before everyone else wakes up to it. I'm going to walk you through exactly what happens in those dark hours between the close and the open, why it matters more for silver than almost any other asset class, and what you need to understand right now to make a decision that doesn't haunt you when the bells ring at 9:30. Here's what nobody talks about when they discuss owning precious metals. Overnight liquidity in silver is a completely different animal than daytime trading. During regular market hours, you see the surface. You see the COMEX trading volume, the ETF flows, the retail buyers and sellers creating what looks like a functioning market. But overnight, that's when the real machinery operates. That's when the big money moves. Institutional funds, central banks, hedge funds with positions that dwarf anything a retail investor could hold. They're all awake in Asian markets, European markets, futures markets that never close. While you're sleeping, they're making bets about where silver is going, and those bets establish the framework for everything that happens when your market opens. Think about this logically. Silver is traded across multiple global markets simultaneously. The COMEX futures market, the physical spot market, ETFs, mining stocks, derivatives, options positioned weeks or months in advance. It's not like owning Apple stock, where basically all the volume happens during one market session. Silver is a 24-hour asset. And the positioning that occurs in those overnight hours often determines whether the daytime session is a continuation or a reversal. It determines whether you're walking into momentum or walking into a reversal. And here's the brutal part. The big players know this. They trade on it. They position around it. They manage it strategically. Think about the flow of information. When you wake up in New York, you're about to hear what happened overnight in Shanghai, Singapore, London. You're about to see the Asian close. You're about to see European trading activity. All of that has already priced in movements, shifts in sentiment, changes in positioning, and then your market opens and retail investors come in thinking they're trading on new information, but they're actually trading on information that was already digested, already incorporated, already weaponized by institutions that move first. It happens in every market. But in silver, because the liquidity is thinner than most asset classes realize, those overnight moves can be disproportionately violent. $1 billion moving in and out of silver overnight creates shock waves. In a market with robust liquidity like the S&P 500, that same $1 billion barely registers. But in silver, it moves the needle. It creates whipsaws. It triggers stops. It creates cascades. This is where most silver holders fail to understand the game they're actually in. They buy silver because they believe in inflation hedging, or they believe the dollar is breaking down, or they believe central banks are buying, or they've read some article that convinced them the gold to silver ratio is mispriced. And look, some of those narratives might even be true, but owning silver based on a belief is not the same as owning silver with a strategy. A belief is something you feel good about. A strategy is something you plan for. A belief makes you vulnerable to every headline, every tweet, every overnight move. A strategy makes you disciplined. And discipline in silver is where most people break down the fastest. Here's what I've learned after 40 years in finance. Price is not a story. Price is a scoreboard. It's the market's real-time verdict on what something is actually worth based on real buying and real selling, not based on what anybody believes about the future. When silver moves overnight, that's not manipulation, and it's not a tragedy. That's price adjusting based on new information, new positioning, new risk assessments. The question is whether you understand what moved it and whether you're prepared for the next move. Let me explain why silver specifically behaves so differently from other assets. First, derivatives. The silver market is flooded with leverage. For every ounce of physical silver that exists, there are multiples of that in futures, contracts, options, and financial derivatives. That leverage amplifies moves. It creates volatility that can look disconnected from fundamentals. When a big fund decides to reduce exposure by selling a large futures position, that sale can trigger automatic sell stops, which triggers more sales, which triggers margin calls, which forces liquidations across correlated positions. You end up with a cascade that looks chaotic, but is actually a perfectly logical response to forced selling. Most silver holders don't understand that cascade. They just see the price dropping and think something is broken. Nothing is broken. That's just how thin liquidity assets behave under stress. Second, the dollar. Silver is denominated in dollars. When the dollar strengthens overnight across global markets, the price of silver in dollar terms automatically becomes less attractive to foreign buyers. Global demand softens. Prices adjust. You don't need any other story. The dollar moves, silver adjusts, because that's a mechanical relationship built into the system. Interest rates have a similar mechanical relationship. Higher rates make holding non-yielding assets like silver less attractive compared to alternatives that actually pay you to wait. When the Fed signals something, when yield curves shift, when interest rate expectations change, that flows through to silver immediately in the overnight markets. By the time you see it in your brokerage account, it's already priced. This is why I keep emphasizing that before markets open is where the real information is. Overnight, you're not trading on hope or excitement or retail enthusiasm. You're trading on institutional positioning, on real money defending or exiting positions, on funds that manage billions and can't afford to be wrong about the direction of a macro asset like silver. When you see silver at a different price at the open than it was when you went to bed, that price difference isn't random. It's the market telling you something. The question is whether you're listening and whether you understand what's being communicated. If this is already making you rethink how you look at silver, subscribe now, because the real takeaway is still ahead. This is not about fear. This is about clarity. Now let's talk about what actually happens in those crucial hours before the bell rings. What are the big players doing? What are they watching for? What moves are they making? First, positioning review. Every night institutions reconcile their books. They look at their silver holdings, their hedges, their shorts, their long positions. They assess whether their portfolio still aligns with their thesis. If they've been long silver waiting for dollar weakness and the dollar actually strengthened overnight in global markets, they need to decide, do they still believe the thesis will play out, or do they need to reduce exposure? If they're short silver on the expectation of higher rates and rates just moved higher in European bond markets, they're assessing whether to cover or extend their position. This isn't conspiracy. This is basic portfolio management. But these decisions happen overnight, and they're being made by people managing positions so large that a single decision moves prices. Second, stop-loss cascades. Imagine you're a retail investor who bought silver at $18 an ounce, and you put a stop-loss at $17.55. You weren't alone. Thousands of other investors did the same. Now imagine an institution based on overnight positioning and risk assessment decides to push silver to $17.54. Suddenly, all those stops get triggered. All that selling hits the market simultaneously. The price drops further, triggering the next level of stops, which triggers stops below that. You get a cascade. It looks violent. It looks like something fundamental broke. In reality, it was just technical stops being run and liquid sellers meeting forced buyers. But if you don't understand that mechanism, you panic. You sell at the worst moment. You lock in a loss based on a technical event that has nothing to do with the intrinsic value of silver. Third, information asymmetry. The institutions have data you don't have. They know what central banks were bidding or selling before it hits the press. They have access to mining data, industrial demand data, ETF flows that are updated in real time. They're getting news from geopolitical sources, economic data from countries that haven't even announced it publicly yet. They're not trading on what everyone knows. They're trading on what they know and what the market is about to discover. By the time information becomes public knowledge, the real money has already moved. That's not unfair. That's the market. That's how it works. Fourth, liquidity management. Silver, like any thin liquidity asset, has periods where it becomes even thinner. Overnight, especially during lower volume sessions, liquidity can evaporate. If a big seller needs to exit a position, they might need to do it in tranches across multiple sessions to avoid causing a panic. But they're also racing against the clock because market conditions can change fast. An institution might be trying to exit a position overnight in Asian markets before the open in New York because they're worried about news that might drop at 8 a.m. Eastern. They want to be out before that news hits. Other institutions are reading the same tea leaves. You get coordinated selling, which looks coordinated to sophisticated traders and looks like chaos to everyone else. None of this is evil. None of this is criminal. This is sophisticated capital allocation. This is what big money does. This is why understanding it matters so much if you hold any silver at all. Let me be very direct with you about something. Most people who own silver own it emotionally, not strategically. They read one article about how central banks are buying gold and silver, and they become a believer. They start seeing silver through the lens of that belief. When silver goes up, they're validated. When silver goes down, they tell themselves it's a dip, that the thesis is still intact, that they should buy more. They convince themselves that temporary price weakness is irrelevant because the long-term narrative is sound. They fall in love with the story so much that they stop thinking like investors and start thinking like fans. And fans don't make money in markets. Discipline makes money. Here's how a disciplined investor thinks about silver. And here's where you need to mentally separate yourself from the crowd. A disciplined investor owns silver for a specific reason, and that reason has defined parameters. Maybe they own silver because they think real rates will stay negative for a specific period, and once real rates return to positive territory, they're exiting. Maybe they own silver because they think the gold to silver ratio will compress, and they have a target price at which they lock in gains. Maybe they own silver as an inflation hedge, and they've allocated a specific percentage of their portfolio to it, understanding that if inflation doesn't materialize, they're taking that loss and moving on. A disciplined investor doesn't need silver to validate their intelligence. They don't need silver to prove that inflation is coming or that the dollar is breaking down. They own silver because it fits a specific scenario in a diversified portfolio. And they're prepared for what happens if that scenario doesn't materialize. This matters before markets open, because if you own silver without that clarity, overnight moves terrify you. They make you reactive. They make you question your thesis at the worst possible moments. But if you understand exactly why you own silver and what you're prepared for, overnight moves are just price volatility. They're noise. They don't change your thesis if your thesis was sound to begin with. They might change the timing of your exit. They might affect your tax planning, but they don't shake your conviction if you never confuse conviction with emotion in the first place. Let me walk you through what a critical moment before the market opens actually looks like and why you need to recognize it. There are specific signals that distinguish between routine overnight trading and genuine inflection points. First signal: unusual volume in silver futures overnight. Volume that's higher than normal for that session is telling you that big money is positioned and moving. It might be coordinated entry. It might be coordinated exit, but it's rarely random. High volume overnight usually means institutions are signaling something. Either they're loading up on a thesis because they believe something about where silver is going, or they're exiting because they've decided the risk-reward has shifted. Either way, when you see that volume, you know something changed in how the smart money is thinking about silver. Second signal: volatility expansion. If silver is moving in a much tighter range during the day but suddenly breaks that range overnight with significant price movement, that's telling you that something new entered the market's consciousness. Maybe it's a central bank announcement from Europe. Maybe it's a shift in energy prices that affects mining. Maybe it's a geopolitical event that changes global growth expectations. But sudden volatility expansion is rarely random. It's usually information being priced in. Third signal: moving average crossovers or technical invalidations. I know not everyone loves technical analysis, but here's the thing: millions of algorithms are watching the same moving average as you are. When silver breaks through a key moving average overnight, especially on volume, you're watching machines executing instructions. Those machines represent collective bets about direction. When they trigger, they can cascade. If you own silver and don't know where your key technical levels are, you're flying blind. Fourth signal: correlation shifts. If silver suddenly starts behaving differently from equities, or differently from bonds, or differently from the dollar, that shift is telling you something about how the market is repricing risk. If silver usually falls when the dollar strengthens, but suddenly that relationship breaks down, that's new information. That's the market saying something fundamental has changed about how it views silver relative to other assets. When you see multiple of these signals firing simultaneously overnight before the regular market opens, that's when you need to pay attention. That's when you need to have a decision ready. That's when you ask yourself, given what I'm seeing, given the direction this is moving, is my thesis still intact? Do I still want to hold? Do I need to reduce risk? Do I need to add? Those are the questions a disciplined investor asks, and the answers should be based on analysis, not on fear or hope. This brings me to something critical that I think most silver holders genuinely don't understand. Silver is not a story asset. You can't tell silver a narrative and expect it to obey. You can't believe hard enough to move price. You can't be right about the fundamentals in the long term and avoid being wrong about the timing in the short term. Price discovery in silver happens in real time, and that real-time price is the market's best guess about where supply and demand actually intersect right now. Not 3 years from now, right now. And that right now is constantly being updated based on new information flowing in from global markets overnight. This is why some of the smartest precious metals investors I know are actually hedgers, not believers. They own silver not because they're betting on it going up, but because they're betting that their other assets will benefit from whatever scenario causes silver to go up. A strong inflation scenario that makes silver rally might hurt stocks and bonds, but the investor is hedged because they own that silver. They're not trying to be right about the absolute price of silver. They're trying to be right about the macro scenario, and silver is just one piece of a diversified bet on that scenario. That's a different mental framework than owning silver because you believe in it. Here's another hard truth. Most silver holders will experience significant drawdowns. Some of them will lose 50% or more of their investment at some point, and when that happens, they'll face a decision. Do they hold because they still believe in the thesis, or do they exit because they can't psychologically tolerate the loss? The answer should be determined by how you feel about your original thesis right now, given what you know now, not by how you felt about it back when you bought. And that requires discipline. That requires being willing to change your mind when the facts change. That requires not allowing your ego to get attached to being right. This is why that moment before the market opens can be so critical. If you're holding silver and you haven't updated your thesis in weeks or months, and overnight you see significant moves that challenge your assumptions, that's when you need to do a hard reset. Not a panicked reset, a disciplined reset. You need to ask yourself, has something material changed about my thesis? Has something changed about the risk reward? Has something changed about my allocation or my timeline? And if the answer is yes to any of those questions, you need to be willing to adjust. You need to be willing to take a small loss rather than waiting for a big one. You need to be willing to accept that you were early rather than being right in a technical sense, but wrong in a practical sense by holding through a catastrophic decline. Let me give you a framework for thinking about this that I've used throughout my career. I call it the odds-based approach. You don't trade based on what you believe will happen. You trade based on what's most likely to happen, weighted by the consequences if you're wrong. So let's apply this to silver. Let's say you believe there's a 70% chance that silver will be higher a year from now based on inflation expectations and central bank demand. That's your thesis. But the consequence if you're wrong is that you lose 30% of your capital. Now let's add the overnight element. You wake up and see that overnight silver has broken through key support levels, volume has expanded unexpectedly, and institutions appear to be selling. Maybe that overnight move is just noise. Maybe institutions are selling because they're rotating into another precious metal or another asset class. But now the odds have shifted. Maybe that 70% probability has become 60%. Maybe 55%. Do the odds still justify holding at the same position size? That's the question a disciplined investor asks. Most people don't do this. They stick with their original conviction because they're attached to being right. But markets don't reward conviction. Markets reward flexibility. Markets reward the ability to adjust when new information enters the picture. And overnight in the silver market, new information is constantly entering the picture. Now, I want to be very clear about something because I think it's important. I'm not telling you that silver is a bad investment. I'm not saying that the narratives around inflation or central bank buying are wrong. I'm not saying you should exit all your silver positions tomorrow. What I'm saying is that how you hold silver and why you hold it matters infinitely more than whether you hold it at all. The same ounce of silver can be a great allocation in one portfolio and a disaster in another, depending on the thesis, the position size, the timeline, and the discipline of the person holding it. Think about this. You can be completely right about the long-term direction of silver, but completely wrong about the tactical timing. You can own silver that will be worth more in 5 years, but lose 40% of your capital in the next 12 months. And your response to that loss will either make you or break you. If you panic and sell at the bottom, you've locked in a massive loss and you've missed the recovery. If you stay committed to your thesis while adjusting your position size and your risk, you survive and eventually profit. These are two completely different outcomes based based on the same asset moving in two different directions at different times. Before the market opens, while price is being set in overseas markets and futures markets and derivative markets, institutions are making decisions about whether they still believe in their thesis or not. They're managing risk. They're managing positions. They're preparing for multiple scenarios. And then when the market opens at 9:30, retail investors flood in with orders, and most of those orders are based on emotion. They're based on overnight news. They're based on reactive decisions made in the last 5 minutes before the open. That's exactly backwards. That's exactly when you need to have thought deeply about your position and made deliberate decisions, not reactive ones. Here's what I want you to do, and I'm being very specific about this. When you finish watching this, I want you to do a full audit of your silver holdings, not a casual check, a full audit. How much silver do you own? How much of your portfolio does it represent? What was your original thesis for buying it? Has anything material changed about that thesis since you bought it? What's your exit strategy? Do you have one? Most people don't. Most people have an entry strategy, and that's it. They know why they bought, but they have no idea when or why they'd sell. That's not investing. That's gambling. And gambling requires luck. Investing requires discipline. When you do that audit, you're going to have clarity. You're either going to realize that your thesis is still sound, your position size is appropriate, and your exit strategy is clear, in which case overnight moves become irrelevant. You're not going to panic. You're going to understand that price volatility is the cost of owning a thin liquidity asset. Or you're going to realize that something has shifted, your thesis is weaker than you thought, your position size is too large, or your exit strategy is vague, in which case you need to take action. You need to reduce risk. You need to reposition. You need to clarify your strategy. Either way, you're going to be better prepared for whatever happens when that market opens. This is the real value of understanding what happens in those overnight hours. It's not about predicting whether silver goes up or down. It's not about trying to catch every move. It's about being prepared. It's about having thought through multiple scenarios so that when you wake up and see something unexpected, you're not caught flat-footed. You have a framework, you have a thesis, you have decision rules. You're not reacting, you're executing a plan. I've watched thousands of investors over 40 years, and the ones who succeed are not the ones who predicted the market correctly more often than everyone else. They're the ones who prepared for multiple scenarios and then executed discipline when one of those scenarios materialized. They're the ones who knew what they were willing to tolerate and what they weren't. They're the ones who separated their ego from their capital. They're the ones who understood that being right in a narrative sense doesn't matter if you're wrong in a practical sense. Silver before markets open is a microcosm of this entire principle. In those quiet hours, the market is being repriced by the people and institutions that move first. By the time you see the news, by the time it hits mainstream media, by the time you read about it on your phone during breakfast, the real money has already made its decision and moved accordingly. Your job isn't to beat them to the information. Your job isn't to predict what they're going to do. Your job is to understand that they're going to do it, and to be disciplined enough to prepare for multiple outcomes rather than betting on just one. I've managed capital through inflation, deflation, currency crises, equity crashes, and every kind of market stress imaginable. And the thesis I keep coming back to is the same one I'm sharing with you right now. The market doesn't care what you believe. The market doesn't care what you hope will happen. The market doesn't care if you're right in theory but wrong in practice. The market only cares about price discovery in real time based on the aggregate of all available information. And that price discovery happens every second, including during those overnight hours when most retail investors are asleep. So when you wake up tomorrow morning, I want you to check silver not just for the price, but for the context. What happened overnight? What direction did it move? On what volume? Did it break through key levels? Did it confirm your thesis or challenge it? Then before you even think about placing a trade or making a decision about your position, I want you to ask yourself, am I responding to new information that changes my thesis, or am I reacting emotionally to short-term volatility? If it's new information, you might need to act. If it's just volatility, you need to stay disciplined and stick to your plan. That's the difference between investors who survive and thrive in silver and investors who lose money. The survivors have a plan, the losers have a hope. If you want to understand moves like this before they blindside you, subscribe to this channel now. Silver doesn't care what you believe, but it will reward how you prepare. That's everything.